Well, it's early in the year and macro forecasts are everywhere, in your inbox and in the headlines. So joining me today to ask how does a bottom-up fund manager like PSG Asset Management include macro thinking into their investment process is Head of Research, Kevin Cousins. So Kevin, to kick us off, can you explain PSG's approach to macro thinking?
Hi, Audrey. So the first thing, as you mentioned, PSG Asset Management is an unashamedly bottom-up house, which in practical terms mean individual investment ideas that we've researched populate our portfolios. The one exception to that is our fixed income team obviously does extensive macro research in South Africa. We would describe ourselves as global macro aware. As a sort of broad description, we pay some attention to it, but historically it's been a finite slice of resources that we've focused on macro. And it didn't matter that much because if you remember, say, the decade from 2009 to 2019, we described it as the secular stagnation. Very little happened on global macro, and certainly one's bottom-up investment theses were the macro variables that you were using were very stable. In early 2021, the world changed, and our research showed a huge increase in macro imbalances in the developed world in particular, and the policy response to the COVID pandemic exacerbated that. Suddenly macro looked like it was becoming very important. And so we started devoting more research hours to macro. Since then, sure enough, macro's got a lot more volatile, and you need to spend more time there.
So Kevin, what are your macro forecasts for 2026?
So Audrey, a typical asset manager does the global macro forecast and then optimizes their portfolios for that forecast. We've got some problems with that. Us and many other very good investors see that macro forecasting is extremely difficult to do. The odds that you get it right are quite slim in the best of times. And even if you get it right, how different assets subsequently perform is a bit of a wild card. Now, these aren't the best of times. It's extremely volatile, as I mentioned earlier. And then you've also got the geopolitical noise can wake up to President Trump's social media posts can turn the world on its head overnight. So our approach is, rather than try and forecast, we actually look at an array of macro scenarios. And then we've done extensive backtesting. What we do is say, in a particular scenario, historically, when that kind of macro environment occurred, how did different assets perform? We've got more than 50 years of backtesting to show us how assets perform in each of the macro scenarios. And then we look at our portfolios and say, if this is what the macro world that plays out, what will it mean for our portfolios? Do we have any unintended bets? And is the outcome likely to be acceptable for our client journey?
But Kevin, everybody does stress testing when it comes to portfolio construction. How do you apply that, or do you do it differently?
Yes, the standard asset management practice, you're quite right, is all the major asset managers use similar risk models. Those models are trained on a similar data set, and they're all searching for the holy grail. They want to build portfolio resilience by investing in idiosyncratic assets. And by that, I mean assets that don't correlate with the rest of their portfolio. There's a problem with that, and this is what concerns us, is that there's a foundational assumption that the historic correlations of assets is a good representation of how they'll behave in the future. And like other foundational assumptions in financial models, it's actually not how the world works in practice. In practice, when there's a market event, a risk-off event, correlations rise very sharply. So that asset that your model showed you to be nicely idiosyncratic and you expect it to protect your portfolio, as markets start collapsing, it correlates and it falls as well. Now, the mechanism that makes this happen is this shared view. So everyone's searching for the idiosyncratic asset. They're all using similar models and similar data. And these assets often end up being crowded, in other words, widely owned, and they often end up expensive. So the only reason that there is to hold it is because of its so-called risk characteristics. And then an event happens and people need to de-risk and sell positions, and that correlation rises. And it's not cheap, and it's not giving you risk protection. It has to be sold. So what we look for as a starting point is a big common sense overlay on the quantitative modeling. And the first thing you'd say, if an asset's going to behave as a safe haven, it's really important to us that it's uncrowded, that it's not owned widely across the market. And then also it's important that it's cheap relative to its history. And if you can build portfolios with quite a few assets with those characteristics, as well as looking at the quantitative modeling, then you're in a good starting position.
So Kevin, taking all of that into consideration, how does PSG Asset Management factor these kinds of insights into its thinking and use that to ensure that the portfolios we construct for our clients enable us to deliver resilient solutions?
Yeah, so if I summarize, the first step obviously is to not try and imagine one macro world and forecast, rather to imagine a variety. So think in different scenarios rather than one, and then make sure our portfolios will be resilient through each of those scenarios. So that's the first thing. The second thing, with our macro research that we do, we tend to focus much longer term on macro regimes and secular change rather than near-term forecasts. And we tend to think financial history rather than quantitative modeling. That's sort of our focus, much longer term. Then the next thing is this overlay. Quantitative modeling from your risk models is all very well, but you need this common sense overlay, especially in assessing how resilient your portfolios are going to be, and we talked about it. The next thing, our biggest risk asset is invariably equities, and historically we've talked to how concentrated equity indices are becoming. So the S&P 500, the MSCI World, these are now very concentrated indices. And instead of a broad representation of the asset class, you're picking up very idiosyncratic risk related to a handful of sectors. So you need a common sense overlay in assessing your equity risk in building a resilient portfolio. And then the final thing, I'm going to use a racing analogy here. So when this hunt for uncorrelated idiosyncratic assets, and the fact that in practice you often the correlations rise and those assets don't behave as you expect. What you see happening in the asset management fraternity is that failure. The response to that is to hold more cash. To use a racing analogy, you drive slower, so you can navigate the sharp turns. Now, we actually believe as long as our bottom-up research is throwing out good equity ideas, we want to actually take a substantial equity bet. But we explicitly mitigate that by buying put options and protection. So we carry more risk, but then we have protection. So the racing analogy would be drive fast, but invest in very good breaks. Because at the end of the day, we want to win the race for our clients. And if you just drive slower the whole time, you're actually not going to achieve their investment expectations.
Kevin, thank you so much for joining me today and sharing your insights and helping us understand how PSG Asset Management used macro thinking to construct more resilient portfolios for its clients.
Thank you, Audrey.